Balchunas, The Bogle Effect, How John Bogle and Vanguard Turned Wall Street Inside Out and Saved Investors Trillions. Dive into the world of John Bogle and his revolutionary creation, Vanguard, into The Bogle Effect, How John Bogle and Vanguard Turned Wall Street Inside Out and Saved Investors Trillions. This captivating summary explores how Bogle's simple and altruistic approach to investing with low-cost index funds disrupted Wall Street, allowing everyday investors to keep more of their money. Discover how Vanguard's unique mutual ownership structure has enabled it to consistently lower fees and offer unmatched value for its customers. The book also touches on the influence of Bogle's philosophy on exchange-traded funds, ETFs, and the emergence of a consumer-driven fee war in the investment industry.
The Vanguard Story. Jack Bogle, the founder of Vanguard, revolutionized the investment world by offering everyday investors an opportunity to invest in low-cost index funds. Vanguard grew to become one of the largest investment companies by offering passive management, simply matching the stock market rather than trying to beat it. They don't rely on outside sales staff, but instead rely on investors to come directly to them. Do-it-yourself retail investors make up 30% of its total assets but account for 90% of the firm's DNA. While Vanguard holds a 29% market share, it only collects 5% of industry revenue. The Vanguard story represents a unique approach to investing, which breaks from the typical Wall Street trappings, and instead, offers a good deal for everyone. The Vanguard Total Stock Market Index Fund was the first to reach $1 trillion in assets and proves that simplicity can be a key factor even in the world of high finance. Vanguard's success secret. In the 1970s, John Bogle founded Vanguard with the aim of empowering investors by making them the owners, a model that has made Vanguard unique and successful in the investment industry over the decades. By letting shareholders decide how to spend the firm's revenue, Vanguard has been able to consistently lower its fees, thanks to the mutual ownership structure. This altruistic approach has cost Bogle lots of money over the years and remained rare in the industry where organizations prefer publicly traded or privately held partnerships. Nevertheless, it has been a prime reason for Vanguard's success over its competitors. Common sense investing. John Bogle's little book suggests index funds as the perfect strategy for investing in stocks. In the Little Book of Common Sense Investing, Bogle shunned stock picking and market timing and instead advocated owning all the U.S. publicly held companies at a low cost. The book contends that an index fund is a bet on the U.S. economy and that average performance is still good enough. Despite being an un-American notion, Bogle's approach to average returns significantly mitigates the risk of outsized losses, thus being an excellent approach to invest. Bogle's vision for ethical investment. John Bogle, a child of the Great Depression, developed a business model in which investment companies work honestly and ethically for shareholders. He championed his vision of low-cost index funds, even when traders were more focused on making quick profits. Bogle's steadfast approach gained momentum following the market crash of 1987, as investors recognized the benefits of index funds. Throughout his career, Bogle remained true to his core principles, such as stay the course and, in the long run, reality rules. Like Benjamin Franklin, Bogle valued frugality and steadfastness, qualities that contributed to his enduring legacy. Disrupting Wall Street's dominant model. Bogle's approach to investing disrupted Wall Street's prevailing model of actively managed mutual funds. Active managers collect increasingly high fees, but their returns consistently lag the market. Despite the rapid growth of the market, they fail to pass on any savings to customers. As a result, the industry generates $140 billion in annual fees. Bogle advocated for cutting the 1% fee, but managers keep it locked in, leading to soaring revenues without a corresponding increase in expenses. The rise of ETFs. Exchange-traded funds, ETFs, are the new and improved version of index mutual funds. They offer low fees and intraday trading. Despite their introduction in the 90s, it wasn't until the financial crisis of 2008 that they became popular. Founder of Vanguard, John Bogle, was skeptical of ETFs, as he considered intraday trading unnecessary. However, with trillions invested in ETFs today, it's clear that he was wrong. Bogle eventually changed his stance and Vanguard became the second largest issuer of ETFs. This decision allowed Vanguard to isolate short-term traders from mutual funds and benefit from tax advantages such as avoiding taxable capital gains. The rise of ETFs has transformed the world of investing and has become a profitable market for investors. The rise of Cheapville. Investors are prioritizing cost ratios over past returns, a shift spurred by Bogle's crusade against management fees. Low-cost funds now dominate the market, with 99% of dollar flows going to those with fees of 0.2% or less. This trend has led to fee shaming and sparked a fee war, with even retirement plans shifting to low-fee index funds. The era of prioritizing past performance is over, welcome to Cheapville. Investors have undergone a change of heart, spurred on by Bogle's decades-long crusade against management fees. Where investors once focused solely on past returns, they now prioritize cost ratios. This shift has been so pronounced that Bloomberg has created a cost obsession thermometer to measure money flows into funds with fees of 0.2% or less, and it shows that low-cost funds captured 99% of all dollar flows in 2018. This change in mindset has sparked a phenomenon dubbed fee shaming. Rather than bragging about their returns at dinner parties, investors now flaunt their vanishingly low expense ratios and ridicule those who still pay active management fees. The cost squeeze has even spilled over into defined contribution plans, which once offered higher fee actively managed funds. Now, most assets in these plans are parked in low-fee index funds. The dominance of low-cost funds has led to a fee war, with some major funds charging as low as 0.03%. The era of prioritizing past performance is over, and investors have embraced a new philosophy where cost is king. Welcome to Cheapville, where investors are proud and permanent residents. The truth about index funds. Index funds are increasingly popular among investors but are not favored on Wall Street. Passive management and low expense ratios have made index funds investor favorites. However, those in active management have a vested interest in undermining index funds, citing concerns such as their ability to create a market bubble. This does not hold up under closer scrutiny as the value of stocks has increased significantly during the same period that $3 trillion flowed into index funds. While there are occasional instances where index funds have behaved foolishly, these have been isolated situations involving small stocks. The criticism that index funds ignore fundamentals and simply buy stocks based on momentum also does not hold up, as markets are inherently prone to irrational exuberance and unwarranted pessimism. In summary, index funds are not a threat to the market and provide a viable investment option for those looking for a low-cost, passive management approach. The uncomfortable success of Bogle. Bogle's investing model led to immense growth at Vanguard, but the swiftness and magnitude of success left him uneasy. Despite being uncomfortable with the company's push for more growth, Vanguard employees respected Bogle's low-cost, investor-friendly goals. However, Bogle's criticism of Vanguard's embrace of ETFs created tension. Still, the tensions never escalated to a full-blown feud, and both Bogle and Vanguard remained dedicated to their overarching goal. The ease of index funds. Investing in index funds or ETFs is easy, but holding on to them is the hard part. CNBC and the financial media perpetuate anxiety by exaggerating small market moves. Humans are wired to buy when things are popular and sell when they're not. Bogle's innovation was to create a diversified index fund to provide a safe haven for investors who tend to jump from stock to stock or fund to fund. By offering simple advice to build a low-fee, diversified portfolio of index funds and rebalance it annually, we can tap into the Bogle ethos without listening to the financial media.
Throughout the Bogle Effect summary, readers uncover how John Bogle's vision for low-cost, passive investing with index funds enabled millions to secure their financial futures. Bogle's lasting impact is embodied in Vanguard's massive success and the changing landscape of the investment industry, with cost becoming the primary focus for consumers. Despite resistance from the Wall Street establishment, Bogle's philosophy of championing the average investor continues to gain momentum. By embracing simplicity, transparency, and an unwavering commitment to the best interests of investors, John Bogle's ideas continue to redefine success in the investing world, showing that sometimes average returns are more than enough to secure a prosperous future.